Hi, welcome to Listen2Riches. Today, I will be decoding the memoir, The Courage to Act, a memoir of a crisis and its aftermath, by former Federal Reserve Chairman Ben Bernanke. In this book, Bernanke recollects the subprime mortgage crisis of 2007 and his specific actions in response to the crisis. It provides us with insights into the origins of the financial crisis and helps us grasp global economic trends. This book offers an excellent perspective on these critical events. Born in 1953, Ben Bernanke pursued his education at Harvard University and the Massachusetts Institute of Technology, MIT. After earning his PhD from MIT, Bernanke embarked on his teaching career, spending a total of 17 years at Princeton University. In 2002, he was appointed as a member of the Federal Reserve Board by President George W. Bush. Then, in 2006, following Alan Greenspan's retirement, Bernanke became the new chairman of the Federal Reserve, holding this position until February 2014, effectively steering the U.S. Central Bank for 8 years. Bernanke assumed leadership at the Federal Reserve just as the subprime mortgage crisis and the European debt crisis unfolded, triggering a global financial storm. The US and European economies teetered on the brink of collapse. During this critical period, Bernanke led the Federal Reserve in taking proactive measures to stabilize the financial markets. As a result, he was named Time magazine's Person of the Year for 2009. While Bernanke's actions to rescue the economy sparked considerable controversy, there is no doubt that he played a significant role in steering the U.S. away from an economic collapse akin to the Great Depression of the 1930s. Due to the unique position of the U.S. economy and the Federal Reserve in the global landscape, Bernanke's policies not only affected the United States, but also had a profound impact on the global economy. In particular, his leadership in implementing the policy of quantitative easing, though it has since ended, continues to have repercussions on the world economy today and in the future. If you wish to gain a deeper understanding of the significance of this historical event, Bernanke's memoir is undoubtedly a must-read. This book, The Courage to Act, spans approximately 560,000 words. Today, I will break down its essential content into 3 parts. Firstly, we will explore Bernanke's economic thoughts and policy recommendations. Secondly, we will delve into how the Federal Reserve, under Bernanke's leadership, tackled the financial crisis. Lastly, we will examine Bernanke's reflections, as well as those of various sectors in the United States, on the financial crisis. First, let's delve into the first part, which is Ben Bernanke's economic thoughts and policy recommendations. Among the various Federal Reserve chairmen throughout history, Ben Bernanke stands out as a rather unique figure. He transitioned from being a university economics department head to being nominated directly by President George W. Bush as a Federal Reserve Board member. After a brief stint in these two positions, he took over as the chairman of the Federal Reserve in early 2006, succeeding Alan Greenspan. Prior to this, he had virtually no prior political experience. This rapid ascent from a university professor to a deputy national leader was nothing short of remarkable. So, why did President Bush place such high regard on Bernanke? This is intimately tied to Bernanke's economic thoughts and policy recommendations. Bernanke's academic background can be traced back to the founder of Keynesian economics, Fisher. His academic interests primarily centered around studying the Great Depression of the 1930s. Bernanke's grandmother had lived through that depression and had recounted the circumstances to a young Bernanke. She mentioned seeing children of factory workers going to school without shoes and asked why they weren't being provided with shoes. The answer was that the factories had closed, fathers had lost their jobs, and the workers couldn't afford to buy shoes. It appeared to be a seemingly inescapable cycle, but the key question was why everyone lacked money. This, perhaps, was the core issue. After embarking on his academic career, Bernanke read Friedman and Schwartz's work, A Monetary History of the United States. In this book, Friedman argued that monetary contraction was the root cause of the Great Depression, a viewpoint that deeply influenced Bernanke. In simple terms, monetary contraction means a shortage of currency, where the money in circulation cannot meet the demands for exchanging goods. This results in products produced by many people not being sold because those who desire to buy them lack sufficient money. Building on Friedman's theories, Bernanke furthered his understanding of the Great Depression and the process of economic crises. He believed that a crisis or depression is a process of the rapid spread and acceleration of panic. It might start from a chance event where there's a temporary shortage of funds in society, which, if viewed rationally, would be a short-term fluctuation. However, concerns spread, ultimately leading to a full-blown panic across society. For example, if a small bank faces fraudulent loans, rationally, this would be a short-term loss. But some depositors worry about the bank's safety, so they start withdrawing their money, which leads others to do the same, ultimately causing the bank to fail. Bernanke believed that in an economic crisis, the financial system acted as an accelerator of panic. The banking system continuously transmitted and amplified panic, ultimately leading to a total economic collapse. This is what Bernanke is widely known for, his financial accelerator theory. Based on this theory, Bernanke proposed a new policy framework, the inflation targeting regime. The goal of inflation targeting is to create a well-defined environment of moderate inflation. The Federal Reserve publicly announced its intention to set monetary policy each year to maintain an inflation rate of approximately 2%. This policy aimed to ensure that there was enough currency in circulation in the market, preventing deflation, and stimulating economic growth. During a period when the dot-com bubble burst, the U.S. economy struggled, and unemployment rates remained high, President Bush was in need of new ways to stimulate the economy. Through the recommendation of economics professor Glenn Hubbard, Bernanke entered the Economic Policy Circle in Washington. In the Oval Office, Bernanke's inflation targeting regime received President Bush's approval. Despite Bernanke's lack of government experience, this did not deter President Bush from directly promoting him to the position of Federal Reserve Chairman. After assuming office, Bernanke swiftly moved to implement the inflation targeting regime, emphasizing transparency and institutionalization in Federal Reserve monetary policy. Fortunately, historical events provided Bernanke with the opportunity to validate his theories. In the summer of 2007, an unexpected subprime mortgage crisis swept through Europe and the United States, casting a shadow reminiscent of the Great Depression. Bernanke took decisive action to prevent the financial accelerator from transmitting the crisis to the real economy and to prevent a reiteration of the tragic events of the 1930s. In summary, in the first part, we delved into Bernanke's economic thoughts and policy recommendations. These can be summarized in 3 sentences. First, a laissez-faire banking and financial system is susceptible to the influence of random events, transforming into a financial accelerator that amplifies panic and leads to deflation. Second, deflation is the primary cause of the Great Depression. Hence, proactive intervention in banking and financial institutions is necessary when crises loom. Lastly, fostering economic growth through crisis prevention requires establishing an inflation expectation system. Now we will move on to the second part and discuss how the Federal Reserve, under Bernanke's leadership, tackled the financial crisis. In the global financial storm that erupted during the summer of 2007, we can roughly divide its progression into 3 stages. Let's explore what targeted measures Bernanke took during each of these phases. The first stage was the outbreak of the financial storm, also known as the subprime mortgage crisis. Subprime mortgages refer to housing loans provided by financial institutions to borrowers with low creditworthiness and low incomes. Typically, during home purchases, individuals are required to provide income verification or financial records, and banks conduct credit checks. If borrowers have unpaid debts from before, they would be ineligible for housing loans. This practice holds true in both China and the United States. However, Why did U.S. financial institutions offer loans to borrowers with poor credit and low incomes? Weren't they concerned that these borrowers might default on their debts? This involves a form of financial innovation. To stimulate the real estate market, U.S. government-sponsored entities like Fannie Mae and Freddie Mac started trading long-term mortgage contracts in the securities market. In other words, after dispersing loans, they sold the mortgage contracts to other institutions in the financial market. This reduced the lending institutions' risks, so they were willing to participate in this business, gradually relaxing their scrutiny of borrowers. Some mortgage applicants with poor repayment capabilities also obtained loans. However, due to inadequate incomes, their mortgage contracts were classified as subprime when traded in the securities market by credit rating agencies. This is the origin of subprime. Initially, subprime loans seemed to work well. All parties benefited. Financially challenged families could obtain loans to buy homes. Lending institutions witnessed a substantial increase in business. Credit rating agencies earned substantial assessment fees. A new category of investment products emerged in the financial market, and the U.S. government saw a surge in enthusiasm, stimulating real estate investments, boosting related industries, and promoting employment. It could be said that everyone benefited greatly. However, human nature is greedy. What started as a mutually beneficial financial innovation began to deviate from the right path under the temptations of greed. The loan requirements continued to drop, scrutiny became more lenient, and in order to generate more subprime loans, financial institutions devised various tactics, including adjustable-rate mortgages and teaser-rate loans. For example, adjustable-rate mortgages meant that the initial interest rates were low, but they gradually increased, making monthly repayments progressively burdensome. This type of loan, due to its initially manageable repayments, enticed individuals with no repayment capacity to hastily sign home purchase contracts. Typically, people might wonder what would happen if these individuals couldn't repay their loans. The lending financial institutions were not concerned because they would sell the mortgage contracts to other institutions in the financial market. As time passed, subprime mortgage contracts without repayment capacity began to default, causing these asset-backed securities to default as well, resulting in a widespread toxic asset problem. Finally, the Big Short came to notice this issue and began massively shorting real estate mortgage-backed securities. Shorting means that when you believe a security is destined to decline in value, you can sell that security short and wait to buy it back after the price falls. If many people short a security simultaneously, the price will drop rapidly, causing significant losses for institutions that had invested in these subprime mortgage assets. This finally caught everyone's attention, and people began massively shorting real estate mortgage-backed securities, leading to the first wave of the subprime crisis. Faced with this situation, Bernanke implemented three major response strategies. First, he assumed the role of a global central banker, providing funding assistance to European central banks to stabilize the financial situation. Second, he opened the Fed's discount window, making loans available to domestic banks and financial institutions. The discount window is a vital tool of the Federal Reserve's open market operations, allowing the Fed to directly lend to financial institutions. Before the crisis, the Fed typically provided overnight loans only to commercial banks. But after the crisis erupted, Bernanke not only lowered the loan rate at the discount window but also extended loan terms to 30 days, later extending them to 90 days and allowing unlimited rollovers, essentially allowing repayment when the institutions were back on their feet. As the crisis continued to unfold, Bernanke also established the primary dealer credit facility, including non-bank financial institutions within the scope of institutions eligible to receive direct loans from the Federal. Finally, when commodity prices were affected by the financial crisis and showed signs of decline, the Fed immediately began lowering interest rates. In less than a year, the Fed lowered the federal funds rate from 5.25% before the crisis to 0%. Unfortunately, these three measures taken by the Fed did not quell market panic, and major financial institutions continued to incur losses. Wall Street financial institutions were hit hard, including the fourth largest investment bank, Lehman Brothers, the third largest investment bank, Merrill Lynch, Citigroup, and the world's largest insurance company, AIG. The entire U.S. financial system was on the brink. In the second stage of the crisis, Bernanke's main approach was to deploy the vast financial resources of the Fed to inject capital directly into private institutions, rescuing those too big to fail financial institutions. Bernanke firmly believed that widespread bank failures were a critical link in deepening the crisis and deflation, and he would not allow a repeat of the tragedy of the 1930s. For example, when Bear Stearns faced bankruptcy, to prevent its bankruptcy from affecting other institutions, the Fed introduced a bailout model involving J.P. Morgan Chase purchasing Bear Stearns and provided it with a $30 billion special loan. In addition, the Fed supported other transactions through bailout models, such as Bank of America acquiring Merrill Lynch and PNC Financial Services acquiring National City Corporation. These measures taken by Bernanke sparked widespread controversy, with some believing that the Fed's intervention was overly aggressive, and the market began to question if there were undisclosed issues behind it. This chain reaction continued until October 3, 2008, when the U.S. Congress approved Treasury Secretary Henry Paulson's bailout plan, launching a $700 billion Troubled Asset Relief Program, TARP. This program essentially announced to the market that no matter how significant the losses were, they would be covered. This was when The Big Short felt that the tide had turned against them, and the wave of concentrated selling of securities of specific large financial institutions eventually subsided. The second stage of the crisis was finally overcome, but controversy and debate persisted, and the Fed's response measures were closely scrutinized. Next, we will explore the strategies employed by Bernanke in the third stage of the financial crisis, which primarily impacted the wholesale financial market in the United States. The wholesale financial market is a unique phenomenon in the United States, originating from the Federal Reserve Act after the Great Depression. The act stipulated that the federal government would only guarantee deposits up to $100,000 in each account, with funds exceeding $100,000 flowing into the wholesale financial market. This market differs from the retail financial market, which directly attracts deposits from customers and includes off-balance sheet activities of banks such as wealth management products and trust plans. Since auditing authorities cannot see these transactions on the balance sheets of banks, it is often referred to as the shadow banking sector. Shadow banks, along with most non-bank financial institutions, conduct financing and lending operations in the wholesale financial market. The wholesale financial market is critical to the U.S. real economy because manufacturing companies such as General Electric and Boeing issue commercial paper and corporate bonds here for short-term and long-term financing. The fourth wave of the financial crisis severely shook the confidence of both investors and borrowers. The lack of market confidence led to a sharp decline in commercial paper trading activity, making it difficult even for strong companies like General Electric to sell commercial paper. Small and medium-sized businesses faced even more severe difficulties in obtaining financing. If this situation was not reversed, it would directly impact manufacturing and consumer spending, potentially causing a true Great Depression. To address this crisis, Bernanke implemented two targeted measures. First, he authorized the Federal Reserve Bank of New York, a subsidiary of the Federal Reserve, to purchase commercial paper directly in the market. This aimed to fill the void left by the withdrawal of private funds and restore market confidence. Second, the Federal Reserve provided guarantees and supported financial institutions in making nearly 3 million auto loans, 1 million student loans, 900,000 small business loans, 150,000 corporate loans, and millions of credit card consumer loans. Bernanke's two measures gradually restored the functionality of the U.S. wholesale financial market, and by May 2009, the U.S. financial system had returned to normal operation. In summarizing Bernanke's response policies during the financial storm, we can see his different approaches at different stages. In the first stage, he enhanced market confidence by means such as currency swaps, direct monetary injection, and interest rate cuts, preventing the spread of panic. In the second stage, facing the deepening crisis, he took decisive action to rescue those too big to fail financial institutions to prevent the entire financial system from collapsing. In the third stage, he actively restored the functionality of the wholesale financial market to prevent the financial crisis from spreading to the real economy. Regarding this series of policies by Bernanke, there were various evaluations and controversies from different parties. From Bernanke's perspective, the outbreak of the crisis was the result of Congress, the government, and Wall Street deliberately allowing the formation of the real estate bubble for their own purposes, along with a fragmented regulatory system unable to cope with the development of modern U.S. finance. He believed that the fundamental cause of the financial crisis lay in the existence of these two factors. In the U.S. economic and congressional circles, there were different opinions and debates about the effectiveness of the Fed's relief measures. Some believed that the Fed's actions were necessary because without them, the financial system could have completely collapsed, leading to more severe consequences. However, some questioned the Fed's intervention policies, believing that they may have led to abnormal market reactions and even provided targets for the Big Short. In the face of such a complex financial crisis, Bernanke and the Fed's decisions faced pressure and evaluations from multiple sides, reflecting the enormous challenges and uncertainties brought about by the financial crisis. In Bernanke's view, this financial storm did not drag the real economy into a prolonged Great Depression as in the 1930s. He believed that this was due to the courage of the Federal Reserve and himself to actively intervene in the market. Bernanke's strategy for addressing the financial crisis can be likened to treating a viral flu outbreak. First, he employed strategies to boost the body's energy, lowering interest rates and injecting liquidity to prevent the economic body from going into sudden shock. Second, he used antibiotics on inflamed vital organs, which meant preventing the collapse of too big to fail financial institutions through capital injections. Finally, he worked on restoring bodily functions, helping the wholesale financial market regain vitality and continue to nourish the real economy. Unlike Bernanke's confidence, there were many in the U.S. economic community who questioned the actual effectiveness of the Fed's relief measures. Some believed that while Bear Stearns was saved, it did not prevent the crisis from continuing to spread. The bankruptcy of Lehman Brothers did not exacerbate the crisis, indicating that the mechanism for the crisis was different from that in the 1930s. In fact, this crisis was not triggered by collective unconscious panic but rather by short-selling activities by large hedge funds. These funds were well prepared and had strong analytical capabilities, with their vitality concentrated in financial institutions deeply involved in subprime business. Another category of criticism focused on Bernanke's rescue of too big to fail financial institutions. Some believe that this rescue disrupted the market's initial clearing mechanism, arguing that capitalism without bankruptcy is like Christianity without hell. For institutions involved in the subprime crisis, they may feel lucky to escape without punishment, and in the long run, this could increase moral hazards in the financial industry. Therefore, more debates revolved around how to improve the regulatory system to prevent another financial crisis. After the financial storm, the federal government and both houses of Congress felt the pain and decided to comprehensively reform the U.S. financial regulatory system. Led by Senate Banking Committee Chairman Dodd and House Financial Services Committee Chairman Frank, they formulated the Dodd-Frank Wall Street Reform and Consumer Protection Act. This legislation redesigned the U.S. financial regulatory system, focusing on addressing regulatory fragmentation. It established the top-level architecture of financial stability oversight through the Financial Stability Oversight Council, responsible for monitoring and addressing systemic risks threatening national financial stability. Simultaneously, the Act established the Consumer Financial Protection Bureau, responsible for regulating financial institutions offering consumer financial products and services such as credit cards and mortgages. Additionally, the Act brought previously unregulated over-the-counter derivatives markets under regulatory oversight. These reforms expanded the scope of the Fed's regulatory authority, giving it regulatory authority over bank holding companies with assets exceeding $500 billion, non-bank financial companies, and large insurance companies. The legislation also stripped the Federal Reserve of its authority to bail out private financial institutions, even if these too big to fail institutions faced operational failure. The Federal Reserve could no longer provide a safety net. Furthermore, the Act required greater transparency in the Federal Reserve's operations and strengthened congressional oversight of the Federal Reserve. The Dodd-Frank Act can be seen as the authoritative evaluation of Bernanke's series of rescue measures by the American public opinion. Finally, we can briefly discuss two related issues that are closely tied to the current economic situation in the United States. The first issue pertains to quantitative easing, which is one of the most significant policies introduced by the Federal Reserve after the financial crisis. This policy aimed to stimulate economic growth and improve employment rates. The Federal Reserve implemented 4 rounds of quantitative easing policies, which lasted for 6 years. By the time Bernanke left office in 2014, the U.S. employment rate had finally approached pre-crisis levels. Internationally, quantitative easing policies also played a crucial role in maintaining global market confidence. However, this policy also raised some concerns, including issues related to balance sheet expansion and inflation. The second issue involves Bernanke's adherence to Keynesian policies, which involve using loose monetary policies to drive economic growth. The actual effectiveness of this policy has been a subject of ongoing debate, especially in the context of global deleveraging. Some economists argue that loose monetary policies only create short-term paper prosperity and do not address the fundamental issues facing long-term economic growth in the United States, such as slow labor force expansion and productivity growth. These problems require broader economic reforms to address. The economic policies of the Trump administration, for instance, took a different direction, focusing on revitalizing manufacturing and enhancing competitiveness. In summary, Bernanke's role during the financial storm and the policies he implemented left a profound impact on history. This period was filled with controversies and challenges, and the effects on the future development of the U.S. economy and regulatory system continue to be closely monitored. Congratulations on completing another book. Thank you for your support and attention. Please subscribe to the channel, like, and share this valuable knowledge with your friends. Let's combine wisdom with practice to achieve our financial goals and create a better future. Thank you, everyone. See you in the next video.